Hey guys, this is Chris Mincola with the Mincola Group over at West USA Realty, and I'm giving you your weekly market update. Some really interesting things happening. And first off, I just want to say, with the stock market down and the bond market also taking a hit, usually when stocks are down, people run the bonds, and then when the bond market's down, people run to the stock market. And then in between there, the story is where people are putting their money right now seems to be even companies like BlackRock, which are really helping drive these housing prices up, are putting their money into housing and more tangible goods. So housing, we see rents are up, over 18% nationally. And so a lot of these things are just really getting us into these different situations that we maybe haven't even seen before in the past. So one of the items I wanted to bring up first is some of the things going nationally. And that is, well, first let's run through our quick stats here. 20 right now we're at 27 closed days on market, 1.13 months supply and inventory, which we'll be talking about. So to see an increase in inventory, we've been below 1 month supply for quite a while. So still lower than we want to see for a balanced market, but our absorption rate is 88.4%, which has decreased quite a bit. And then our average sales price is still right around that 595.9 mark, and our list to sales price ratio is 101.47. So there's being a list of that. It's going for just a little over 1% of what the homes are being sold for, but there's been a shift in those numbers too. One other thing I would like to note here that's going to kind of piggyback off where we are in the Phoenix market internationally too, is this idea that, oh, the sky's falling and everybody's going to be in foreclosure. Well, in our market right now, just for the example, we've got basically 0% increase or decrease in short sales, and there were 12 in the entire inventory this past week, 12 properties in short sale. Lender owned REOs, that's basically they didn't sell at auction, so now the banks are putting them back on the market. Real estate owned properties, REOs, lender are owned, those are down 15%. Okay, so those are a type of distressed property. And then HUD is down 33% as far as HUD property. So this whole kind of category of distressed inventory is down. So we're not seeing any influx of what people are running around talking about as far as sky falling. But when we look at the numbers nationally, just real quick, just to kind of go into this a little deeper, when we look at foreclosure and forbearance, remember forbearance was the idea that people got a little bit of a reprieve or safety net when the COVID pandemic hit, and we had the loans upon existing forbearance programs. And here's how it shakes out currently. 37% were paid in full. Okay, so they received the forbearance help during the pandemic, and 33% have been paid back in full. 44.6 were workouts or repayment plans. And out of those, remember, not everybody went into forbearance, right? So this is a very small segment of the population to begin with, but 18.4% were still in trouble. So out of everything that we've seen since the pandemic hit in 2020 and the forbearance programs came into play. So it's a very, very small amount of people that we're talking about that were still in trouble, that took the forbearance and dealing with possible issues with making their mortgage payment and or foreclosures. So again, I'm getting these stats from Keeping Current Matters and Bankers Associations, where they came from, but 413,480 fewer foreclosures in the past 2 years. And obviously part of that is the forbearance issue, but also the fact that people have so much equity, right? They have tons and tons and tons of equity right now because prices have gone up so much. So we're talking again about a very small segment of the population where we're seeing this in the Phoenix area. It's almost non-existent. All right. So those numbers are what they are. You can, some people still want to believe that the sky is falling as far as foreclosures go. Doesn't mean things couldn't shift in the future. Nobody's got a crystal ball, but we can only go by the numbers we have and the indicators that we have. Okay. One other thing to keep in mind is when you look at the whole, again, across the country, this is national right now. I'm talking about national for this portion, foreclosure and forbearance section here that I'm talking about. We've got 2 months worth of inventory. A balanced market would be 6 months. Yes, 6 months of inventory would be a balanced market. Okay. That means 6 months of inventory. That means if nothing went on the market from now for the next 6 months in a balanced market, you would have enough inventory to handle that. Well, right now, if nothing else were to list, we would have 2 months worth of total national inventory for residency. And again, this deals with single family residency. So just some idea there on the forbearance sky is falling type of things that you hear sometimes, and even the national news likes to sensationalize all that stuff going on. I'm not saying inflation's not an issue. It's a tax that's horrible for everyday working people. The elites and the top end, it doesn't matter to them. They'll just shift over to more real estate or gold or whatever. But it is interesting that, again, can't go to stocks because the bond market, can't go to stocks because stocks are down and people can't run to the bond market. So we're seeing interest rates going up. We're seeing that is causing a little bit of a cooling trend, which I'd like to talk to you a little bit more about. So that's, again, we would have to have a huge flood of inventory, though. Huge flood of inventory. We are seeing a little bit of increase in inventory, but we'd have to have a huge flood of inventory in order to make this a balanced market. And we're just not seeing it yet. Okay. That doesn't mean we might not see it, but we're not seeing it yet. Okay. So, hopefully people are being advised properly if they are getting behind in their payments, whether or not they took advantage of the forbearance program, whether or not they looked at maybe doing cash out refinances to help themselves. Maybe they went into the idea of maybe moving on, selling their property, getting the equity out and buying something else. And there's other things that could be done too, but hopefully they're being advised properly. And how would you get advised properly? Well, talk to your local realtor that you trust. Obviously, we'd be here to help you with any questions, your financial people, your attorneys, and all that sort of thing. So 3 things to look out for before we can see true values and prices affected. Pricing is usually a lagging indicator in any market. So the number one thing is price changes. Okay. Per week, we kind of watch this. And since January to May, we've seen a 40% increase from January to now in price cuts, 40% increase. So that's one box you can check. That's one indicator. Okay. But there's 2 other indicators that we need to look at. Okay. Days on market. Okay. Right now, days on market, as far as properties that go under contract, days on market, how fast are they going under contract? Okay. When I say days on market, I don't mean total days. I mean, how fast are properties going under contract? Okay. That hasn't really changed much. It's been about 7 to 8 days. And it's kind of holding steady there. Now, obviously around the holidays, that number does fluctuate a little bit, where we see maybe that number double or triple, but that's typical during the holidays, during, November, December, and New Year's, right? So 7 to 8 days is where we're kind of holding steady at for quite a while now, for several months on end. And then the third thing we would look at, so number 2 hasn't changed, number 1 has, number 2 hasn't changed. And then number 3 is the percent of seller concessions. So are the sellers paying any closing costs or helping you with closing costs or incentives on their end on these resales? And overall in the Phoenix area, we're seeing about 3% of total closing costs being paid from February to April. it kind of started that trend around February to April of 2020. We saw that going into a trend, and now we've just been kind of holding steady there for quite a while. Closing costs paid, way back before that trend started to happen was, right around 25%. So it hasn't moved from that since that. It's been kind of holding steady at that 3% across the board, give or take a little bit. So again, before 2020, February to April of 2020, before that, we were seeing about 25% seller concessions being paid out. Now we're seeing 3%. We have ever since. So we also need a lot more supply, which I mention all the time. And the Crawford report, which we use, and we'll talk about our CMA here in just a second. Everybody usually tunes in for that. CMI, I'm sorry, not CMI, not CMA, CMI, Crawford Market Index. The Crawford report people have also come out with the Crawford contract ratio. So they take the number of listings that are under contract and they times it by 100 and they come up with this index. So 100 plus would be a frenzy market. We've seen that over the last several months, from January to May, we've seen a decrease from 350 on that frenzy index, or that Crawford contract ratio index. We've seen it go from 350 down to 150. Okay. And this deals with supply and demand. So from January to May, we've seen a fluctuation there from 350 down to 150. So, what the supply is and demand is for is basically what this tells us more specifically. So what they say about this is, and I'll pretty much read this word for word, when it comes to this graph that they use in an indicator. The previous crazy hot market has turned into just a hot market. But if the cooling trend continues at a similar rate, we could be in a warm market in a month, and a regular market in just 2 months. Okay. The former is likely, and the second is more speculative. And anyone who tells you that they know what the market will be doing in 3 months is kidding themselves. So we'll see. We'll keep an eye on this, see how things trend. Again, we are seeing, an increase in supply, a decrease in demand, which we'll talk about here right now. And, that's obviously creating this difference in this, very hot, super hot market compared to just being in a hot market and maybe possibly going into a warm market, and then maybe even a more of a normal market. So on the CMI this week, and the supply and demand indicators, we see that demand is down. Okay. And this is obviously, again, walks like a duck and talks like a duck. It's obviously due to, prices have gone up, but more importantly, interest rates have gone up. Remember, for every, earlier this year or the end of last year, we were around 3% interest rates. Okay. Now we're in the fives, and, the Fed just raised the rate 0.5%. Why? Because of inflation. So they've got to, basically, in a nutshell, they've got to raise rates in order to combat inflation, even though, I would argue that this inflation is kind of manufactured. Not that it's not real, but that it doesn't need to be there for a lot of reasons, because of our energy sector and our food sectors and things like that. That's another discussion. But that said, it is what it is, right? We still got inflation. So what do they do to combat that? They raise interest rates. The Fed raises interest rates, and they just did that again recently. We're probably looking at, I would guess, at least 1 to 2 more this year, and probably 2 to 3 more next year. We'll probably, according to what some of the best gurus will tell us, is once we get into this recession coming up here in about, the next quarter, probably, and beyond, is we'll probably be in that for about a year to year and a half, to where they'll kind of offset some of that cost, and then hopefully we'll see interest rates drop back down. Okay. I wouldn't wait to buy if it were me, only because then you're losing the equity and you need to have some sort of hedge against all this inflationary factors. But once those rates do drop, let's talk, let's get you refinanced and so on. So, but remember, for every interest rate hike, so from 3 to 5%, now we're over 5%, but from 3 to 5%, that's a 20% increase in your payment, or 20% less buying power that you have. Okay. So for every 1%, it's 10% basically in, a hit to your buying power or your payment. So demand is at 99. The number this week is 99.7 on the Crawford Market Index. The demand is 99.7. Again, due to rates about 1% below where it should be in those numbers. So it's under 100. And then we've got the supply is at 29.1. And again, on the overall index, 100 is a balanced market, over 110 is a seller's market, and under 90 is a buyer's market. But when we're talking about supply, 29.1 is up from where we were. We were kind of hovering there between 23 and 24 for quite a while, seemed like forever. But now we're at 29.1, which equals about 71%, still below the normal for supply, 71% below normal for supply. Again, 100 on the supply would be normal. So, again, we've seen this, influx in supply, which we talked a little bit about, a little bit more of last week. So we went from around, we were right around 5,000-6,000 inventory. Some weeks we were, in the fours. And now we're hovering around 10,000. Okay. We would need to double or even triple that in order to really be in a fully balanced market and hold there consistently. But the overall CMI, the overall Crawford Market Index, is 342.2. Okay. And for every single city in the entire index, we're seeing that the CMI is down. So we're seeing that, that is degrading the seller position more and more as we go down. We were just at, 380 not long ago. We were over 400. We were in the high fours not long ago. So, we'll again continue to keep an eye on this, but all cities CMI index is down. Okay. Overall across the board. And we see over the last month, we were down 20.5%. And last week, month to month, we were 18.1% down. So we will continue to keep an eye on this. Make sure that you tune in every week. Subscribe to us on our YouTube channel. Check us out on our Facebook page. Our Instagram is a work in progress. We are doing some extra work on that right now. We'll be getting that caught up. But check us out there. And also, if you'd like to subscribe to our weekly emails, we'll include that in there too. Guys, if you have any questions at all, always feel free to give us a call or text us at 480-788-8569. That's 480-788-8569. Or you can email us at home@mincolagroup.com, home@mincolla group.com, or check us out at mincolahomes.com and mincolagroup.com. We'll see you next week, guys, and we'll keep you updated on everything going on in the market. Always feel free to also click the tabs if you want to set an appointment, or just check your home evaluation tabs. We can get you more information in your local area on the indexes and where things are, and get you a more of a market analysis and a home value in your area if you have any questions. Thanks a lot. We'll see you next time.